A new year and a new policy from China's Customs Tariff Commission. Starting January 1st, China will adjust its tariff rates on select imports and exports. Lower provisional import tariffs will come into effect on over 1,000 commodities. It includes critical equipment, medications, certain food, and agricultural products. China will also reduce the export tariff on high-purity aluminum. It also plans to raise import tariffs on petrochemicals. Joining us now to discuss the possible implications of these tariff rates changes on imports and exports is John Gong. He's a professor at the University of International Business and Economics in Beijing and a China Forum expert. Happy New Year, John.
Happy New Year. Thanks very much for having me, Elaine.
Well, John, let's get into this. Explain the new tariffs for us and what's behind these adjustments and what are they meant to accomplish?
Well, I think the Biden administration has been talking about hiking the tariffs, particularly related to electric cars, for some time. But a very good development, in my view, is that U.S. Trade Representative Elaine decision to extend the tariff exemptions up until the middle of the year, which is a very good sign. And I think from China's perspective, China is committed to the RCEP trade tariff reduction over the long run. It is phasing out a lot of the tariffs gradually. So I think, if you look at the China's largest trading partner, United States situation, I think it's a fact that we have to all face that China indeed has a very large trade surplus with the United States. And I think I can understand from Washington's perspective, there's a legitimate concern about at least working towards a more a balanced trade direction. Nevertheless, I think tariffs doesn't work. And I think probably a more effective method is to allow Chinese investors to go to the United States to set up their operations there, as some electric car battery companies been thinking about. When the problem is the political climate in Washington D.C. is not so much accommodating these kind of investments, and that's very unfortunate. I think ultimately it's the American consumers are paying for a high price as well as the tariffs containing a high price, and it's a very difficult situation, especially against the backdrop of the prospect of Donald Trump coming back again next year. And I think this is going to really scary scenario in my view. I think we're going to face a totally decoupling picture about the trade between the United States and China if Donald Trump comes to power. His the most influential trade advisor, Reyes, has been saying this all along. He's written a book about this, that advocating essentially decoupling from China.
Well, John, let's start with January 1st because we want to talk about the types of businesses and industries in which China will benefit from reduced import tariffs. So let's not get to Trump yet, but looking at the immediate future, what are we seeing there?
Yeah, well, I mean, from China's perspective, as I said, China is committed to these trade reductions as containing the RCEP agreements, and I think the most important thing is that China is the world's largest exporter and also the world's largest trading nation. Without opening up the market, without further reducing the tariffs, in my view, China's trade, particularly exports, it's not going to sustain over the long run. China's trade surplus, which is quite sizable, is not going to be sustainable over the long run. So I think China needs to increase imports. And one of the effective means is to reduce trade tariffs. I think this is particularly a acute issue with respect to some countries that has a very large trade deficit with China.
Yeah, what are some of those countries? What does this mean for some of those other trading partners? And then I guess to round it out, what is your outlook for Chinese trade in 2024?
I think overall, China's trade eased out a very small, I think it's less than 1% growth over 2023 last year, which is still quite acceptable in my view against the context of slowing down global demand. And I think probably we're going to maintain the same picture. But again, I want to talk about the United States because clearly China-U.S. trade, I mean, America is China's largest trading partner from a single country's perspective. And this is, about, I think, $600 billion of trade relationship. And the problem is that this big piece of the cake is going down. I think there are a lot of challenges with respect to that trade, particularly as I see it. The political climate in Washington D.C., the Biden administration and the future administration's trade policy towards China is really concerning to me. With that piece, if that piece is gone, that would be a huge blow to China's trade. I don't think it's going to be picked up by increased trade with, say, Russia, Vietnam, other ASEAN countries. The United States, by and large, is still the largest trading partner of China.
All right, Professor John Gong, always great to see you and get your take in this new year. Thanks for joining us.
Thank you.